What is repricing gap, and how does it impact banking book hedging? Repricing gap is a concept commonly used in risk management for banks. It refers to the difference between the maturity of a bank's assets and liabilities. In other words, it measures how quickly the interest rates on a bank's assets and liabilities can change. Understanding repricing gap. Banks engage in various activities that expose them to interest rate risk. They borrow money from depositors and other sources, and they lend it out to borrowers. These activities create a gap between the rates they receive on loans and investments, and the rates they pay on deposits and other liabilities. The gap can be positive or negative. A positive gap means that the bank's liabilities will adjust, faster than its assets in response to changes in interest rates. Conversely, a negative gap means that the bank's assets will reprice faster than its liabilities. Impact on banking book hedging. Repricing gap is a crucial consideration when it comes to hedging the banking book. Hedging involves using financial instruments to reduce or eliminate potential losses due to interest rate changes. The goal is to create an effective hedge that will offset the impact of interest rate fluctuations on the bank's net income and economic value. Banks with a positive repricing gap often seek to reduce their exposure to rising interest rates. They can do this by using interest rate swaps or other derivatives to convert their fixed-rate assets or liabilities into floating rate, or vice versa. By doing so, they can protect their profitability in case interest rates go up. On the other hand, banks with a negative repricing gap may choose to hedge against falling interest rates. They can use derivatives to convert their floating rate assets or liabilities into fixed rate, or vice versa. This helps them mitigate the risk of declining revenues in a low-rate environment. Challenges and considerations. Repricing gap hedging is not without challenges. One of the primary difficulties faced by banks is accurately forecasting interest rate movements. Economic conditions, market factors, and unpredictable events can all impact interest rates, making accurate predictions challenging. Another consideration is the cost of hedging. Banks need to assess the cost-effectiveness of the hedging strategy they employ. They must carefully balance the potential benefits of hedging against the costs involved in implementing and maintaining the hedge. Conclusion. Repricing gap plays a significant role in banking book hedging strategies. Understanding the gap and its impact on a bank's assets and liabilities helps institutions manage interest rate risk effectively. By utilizing appropriate hedging techniques, banks can protect their profitability and navigate the changing interest rate environment. Want to learn more? Claire Trifle on LinkedIn.